see if we're on the air. Okay. Hello, everybody, and thanks for coming. I really appreciate you turning out today for our event. I'm Tom Miller, Professor of Finance here at Mississippi State, and the inaugural holder of the Lee Chair in the Jack R. Lee Chair, in Financial Institutions and Consumer Finance. I'm the moderator for today's event. Through the Lee Chair, we welcome distinguished scholars of law and economics to Mississippi State to discuss research and current events at the crossroads of law, economics, finance, and policy. I want to acknowledge at this time Mr. Frank Lee, a distinguished alum from Mississippi State, and he has helped me over the years plan, host, and enjoy the Lee speakers, as well as helped me in my career, and I really appreciate that. Last year, as you know, we didn't have a Lee speaker because of the COVID-19 pandemic, but to resume our speaker series in 2021, what we decided to do was welcome back our very first two Lee speakers, Dr. Mark Calabria and Professor Todd Zywicki. To kick off our event, recall that the definition of consumer credit is any debt not secured by real estate, that is, credit cards, student loans, automobile loans, personal loans, and the like. So if we add mortgages to the mix, we have all the legal sources of credit that's held by consumers. So by design, our event today brings together two exceedingly well-known and highly regarded experts in consumer credit and in the mortgage market. So it's my distinct honor and privilege to have been able to work with each of these guests. They've been very helpful in my career, and it's always a pleasure to see them. And so I've learned a lot, and I think you'll learn a lot from them too. I will introduce our guests and give a brief list of some of their career accomplishments, which will take me a long time if I went through all their accomplishments, but there you'll see from my synopsis, they're both quite impressive speakers. On my right is Dr. Mark Calabria. The Honorable Mark Calabria, PhD, is the most recent former director of the Federal Housing Finance Agency, that is the FHFA. To me, an interesting highlight of his career is that Dr. Calabria once served as senior aide to the United States Senate Committee on Banking, Housing, and Urban Affairs. During his Senate service, he acted as the primary drafter of the Housing and Economic Recovery Act of 2008, which formed the FHFA. The FHFA supervises major participants in the mortgage market. That is, it supervises, I have to read this, the Federal National Mortgage Association, the FNMA, i.e. Fannie Mae, the Federal Home Loan Mortgage Corporation, FHLMC, that is Freddie Mac, as well as the 12 home loan banks in the United States. By the way, the assets held by Fannie and Freddie are massive. In 2017, they held their combined assets was $5 trillion. For scale, that's 25 times the assets of Walmart. Before heading to the FHFA, Dr. Calabria served as chief economist to Vice President Mike Pence and worked closely with him. In his role as chief economist, Mark served a key role on the team that enacted the Tax Cuts and Jobs Act of 2017. Dr. Calabria has recently returned to the Cato Institute in a role of a senior advisor. During his previous stay at Cato, which was around 10 years, Mark worked diligently to establish the Cato Institute as one of the leading voices in financial reform, particularly mortgage finance. Dr. Calabria regularly provides expert commentary on radio, many television shows, as well as in print at all the major financial outlets, has testified before Congress multiple times. He holds a doctorate in economics from George Mason University. To my left is Todd Zywicki, the George Mason University Foundation Professor of Law at Antonin Scalia Law School at George Mason University. From 2020 to 2021, he was chair of the Task Force on Federal Consumer Financial Law, an important group formed by the Consumer Financial Protection Bureau, i.e. the CFPB. The task force produced over 100 recommendations to strengthen consumer protection across all financial markets. Professor Zywicki has an impressive academic resume. Here are some highlights. In 2021, he was inducted to the American College of Consumer Financial Services Lawyer. He served as co-editor of the Supreme Court Economic Review from 2006 to 2017. From 2003 to 2004, Professor Zywicki served as the director of the Office of Policy Planning at the Federal Trade Commission. Professor Zywicki is a senior fellow at the Cato Institute, a Lone Mountain Fellow at the Property Environment Research Center in Bozeman, Montana, by the way, and a Fellow of the International Center for Economic Research in Turin, Italy. Professor Zywicki is former chairman and a current member of the board of directors of the Competitive Enterprise Institute and is a member of the board of directors of the Institute for Humane Studies. Professor Zywicki is a prolific writer. He is the author of more than 130 articles in leading law reviews and peer-reviewed economics journals. He also provides expert legal advice, commentary on radio, television shows, and in print in all the major financial outlets. He has testified before Congress multiple occasions on consumer bankruptcy law and consumer credit issues. Professor Zywicki received his JD from the University of Virginia and his MA in economics from Clemson University. So won't you join me in giving them a warm bulldog welcome to Mississippi State. So at this time, what I would like to do is we have kind of a, as you'll see, both our guests are quite articulate and can say many things, and so it's my job to kind of like try to throw out the anchor occasionally, but we want this to be a conversation about consumer credit and mortgages, and so we really don't have a rigorous agenda. We will have a question and answer session at the end, so I encourage you to answer any questions. So to start, what I'll do is ask each of our guests to provide an opening statement that with a focus on the history of their of the FHFA and the CFPB, and kind of like tell us what's the function of these federal agencies. So, Mark, I will ask you to go first.
Thank you, Tom, and of course, thank you for that very generous and kind introduction. It's interesting because both the CFPB, which Todd is going to talk about, and FHFA, that I'm going to talk about, were created in the aftermath of the financial crisis. FHFA was created in 2008, and obviously CFPB was created in 2010 as part of Dodd-Frank. And in some sense, they were both a reaction to problems in the mortgage market. I mean, there were some obviously broader consumer issues that I know Todd will talk about, but there was a real sense in 2008 that the Great Recession, the subprime mortgage problems, and of course the rescues of Bear and AIG and Fannie and Freddie, and of course the failure of Lehman, all of these things came out, and of course, so Congress, as it's wont to do, did a lot of box rearranging, if you will. So, for instance, the agency that I run, or was running, was the merger of two pre-existing agencies, one of which oversaw directly the regulation of Fannie and Freddie, and the other one that saw the overregulation of the federal home loan banks. Now, the primary difference between FHFA and CFPB is FHFA is what's called a prudential regulator. So it's not consumer-facing. Its primary purpose is not to make sure you don't get taken advantage of as a consumer, but its primary purpose is to make sure that the entities underneath its purview are operating in a safe and sound manner. So, you know, they've got liquidity, they've got capital, they're being examined to make sure they're not, you know, misbehaving. And, of course, the primary concern is that given the interplay of the mortgage market to the economy, of course, not only was mortgage policy central to 2008, you know, it's really been central to so many other crises. And, you know, for instance, even in the Great Depression, you know, we had tons of mortgage market failure, mostly farm mortgages at that time. We've repeatedly seen the savings and loan crisis was driven by mortgage. If you have never read Rogart and Reinhardt's terrific study of financial crises in history, they point to fundamentally three things, you know, exchange rates, sovereign debt, and property markets. And so needless to say, property markets are consistently ways in which countries around the world, particularly the United States, have found themselves in trouble. And unfortunately, that probably will be the case in the future again. So FHFA was created to make sure that we could have a strong set of regulation to deal with the moral hazard implications of essentially implicit guarantees around our mortgage market. And again, to maybe emphasize again some of the points that you've mentioned, today, the combined footprint of the entities regulated by FHFA is about $7 trillion. You know, the debt outstanding for Fannie and Freddie is greater than the capitalization of NASDAQ, for instance. And not gonna pick on our friends who study equity markets, but you know, the Fannie Freddie agency debt market is second only to the Treasury market in terms of importance. And whether you look at, say, money market mutual funds, government mutual funds, the holdings of agency debt are just tremendous throughout the system. And of course, insured depositories hold a lot of agency debt. So that is a way in which Fannie and Freddie and the Federal Home Banks are so systemically important because they're just spread throughout the rest of the system. And again, our job at FHFA was to try to make sure they were safe and sound, they didn't represent a threat to the system, because again, as many of us saw in the Great Recession after 2008, when the mortgage market goes sideways, you can really do a lot of damage to your economy.
Thank you, Mark. Todd?
As Mark mentioned, the CFPB also came out of the financial crisis, and many people thought at the time that one of the causes of the financial crisis was a deficit of consumer protection at the federal level. I remember Mark and I testified together in Congress a few years ago, and I think there was a lot of imprudent lending, but it's not clear to me that there were consumer protection problems there as opposed to just imprudent lending, which is a different story. But nevertheless, there was a perception that there was a need for a national consumer financial regulator. And regardless of the proximate cause of it, I think there was. I think the idea of a single national regulator to handle consumer financial protection was a good idea. Prior to that, consumer financial protection was spread out among all kind of different agencies. The prudential regulators had some, the Fed, the OCC, the Federal Trade Commission, HUD, all these different entities. And I recall when I was at the FTC back in the early 2000s, to try to do anything on consumer financial protection was like a United Nations meeting, right? To try to come up with anything. And it just was a system that didn't work very well. And so regardless of what prompted the CFPB, I think the idea of doing something like that, it could have been part of an existing agency like the FTC, I think might have made sense. They chose to create a new agency to do it. And they kind of hit the ground running. Congress gave them a lot to do. They gave them a very big budget. There were several mandatory rulemakings right out of the box, including several mortgage regulations. But then they picked up a lot of other things after that. And so when we came in as part of the task force, coincidentally, it was basically the 10th anniversary of the agency. And so it was actually a good time to take a look back as this agency sort of went from being a startup organization that arose out of a crisis in a very political environment, and then think about how you transition from being a startup to being a mature agency to kind of chart out a course for the future.
Okay, and actually one thing that I noticed or came to us during our lunch conversation is that you guys both worked during the pandemic in 2020. And so you were both doing your task force and running the FHFA during the pandemic. So can you talk a little bit about how the pandemic impacted your work at the agencies?
I mean, certainly you could say it. I mean, it consumed our work at FHFA. I mean, so I'll start with, I inherited companies, Fannie and Freddie, when I walked into were leveraged 1,000 to 1. Fair to say nobody survives bumps in the road at that kind of leverage. And so fortunately by the time COVID hit, they were only leveraged at 150 to 1, which was still far too much leverage for financial companies to operate at, but we had been able to build capital, and we were certainly in the process of strengthening the companies and strengthening the system. And we really first and foremost looked at COVID as a public health crisis, and of course, like everybody else, we were finding information as we went along. We weren't epidemiologists. We were mostly economists and lawyers. But we really looked at this and said, okay, we need to prioritize the ability for people to socially distance by staying home. And, obviously, if you lose your house to foreclosure, if you're put out on the street or you lose your house to a mortgage, you're essentially going to be exposed potentially. And again, this is at a time when nobody really knew what the path of this was going to be. So, for instance, when the national emergency was declared by President Trump, you had about 200,000 Fannie Freddie borrowers who were already in deep delinquency facing foreclosure. So you're talking families who might not have paid the mortgage in 2 years, really were beyond getting back on their feet financially, but we couldn't put them on the street. So we pressed pause and said, listen, we're going to keep you in your home, and we'll figure out another way to pay for it one way or another. And then we set up forbearance programs. And again, one of the things that in contrast to the 2008 crisis, and there's probably nothing that finance academics love more than the debate whether 2008 was a liquidity or solvency event. We're probably debating that for a few more decades. this was very clearly from the consumer side a liquidity event.
Right.
You had a huge job market loss. The hope was, of course, that people would get reemployed. You by and large had substantial equity in borrowers' homes, and in fact, for Fannie and Freddie borrowers who entered forbearance, less than 1% had loan-to-values even over 97. The typical loan-to-value for a Fannie and Freddie forbearance loan was about 70%. So they had equity in the home. They really wanted to stay. It was really just that shock, particularly to the service and retail sector. We also noticed very early on that only about 40% of March 2020 job losses were people with mortgages. Predominantly, again, if you think about the job losses being retail, service sector, predominantly a renter crisis, which also meant we need to come up with new renter solutions we hadn't had. But again, it was really just press pause. We were allowing people to take a break on their mortgage payment, again, if they needed it. So it wasn't meant to be, here's a free mortgage moratorium, free rent. It was meant to be, we're going to give you breathing room while the job market recovers, so that we aren't pushing people out of their homes with the potential that would be exposing each other to COVID. And it really was meant to be fairly short term. One of the benefits, I spent the 2008 crisis on the banking committee in the Senate working for Mr. Shelby, you might know from your neighboring state of Alabama. And really, I took away a lot of, here are things that I thought were done quite poorly. And we had a lot of these modification programs, HARP, many of these things that were set up post-financial crisis that I don't think were dealt with well. And so we made sure that we set up something that was much more effective. And so, for instance, and again, there were decisions we had to make on the fly, often with not full knowledge, and many ways not knowing how they're going to turn out. So let me wrap up by talking about, to me, maybe the biggest gamble, I took as a leader during that time, is one of the real problems in 2008 with the modification program with borrowers was there was just a tremendous amount of information required. It would often get lost between the borrower and the lender, or there would be errors, and so it would take months and months to get people in the forbearance programs. And of course, they were often tied to income. So one of the things we didn't want to do was create a disincentive for people to get back to work by tying their mortgage payments how much they were making. But more importantly, I looked at this and said, we cannot spend 6 months having people go through applications to decide whether they're going to be able to get a forbearance program. So we set up an honor system. And I probably was about the only one on TV going on and saying, if you don't need it, please don't take it. Only take this if you need it. Because like the healthcare system, we were going to have to triage financial assistance of those families who were most likely to lose their home otherwise. And at least for what we saw with the data at FHFA, it really wasn't abused. By and large, the people who took forbearance were people who needed it. In fact, about a fourth of people who took forbearance paid the entire time. They just kept it as a liquidity backstop, continued to pay their mortgage. And again, it was never going to be forgiven. You were always going to have to pay it back. And we also set up a fee on refinances to pay for it. So I'm actually, in this day and age when people throw around $1 trillion here, $1 trillion there, we provided an assistance program that helped literally millions of people stay in their homes, and we paid for it all completely without a penny of taxpayer assistance.
Wow,
I hope that's a model that others can start to use.
No doubt. And so, Todd, you and the task force were working, and by the way, just so you know, the task force report was released on January 6th of 2021. So that date might have other meanings to people. But so kind of, as I recall, the task force had a set time to work, and it was basically all during COVID.
That's right, Tom. And first, I want to acknowledge what Mark just said was I think that the federal regulators did a remarkable job in dealing with the pandemic, both Mark as well as Director Kathy Kraninger at the CFPB, in using the tools that they had available and the resources they had available to them, because the financial system isn't set up very well to deal with crises like this. It's a very rule-bound, very static kind of system that's got thick layers of overlays and that sort of thing. And so one of the reasons the task force came into being was because we were already becoming aware that there was a need for modernization of the consumer financial protection system. And the CFPB was part of that. And what we've seen in American history is there's been sort of these 50-year cycles of consumer financial reform going back to the 1920s. and the Russell Sage Foundation, where people moved into the cities. Immigrants, people came in from farms and agriculture, and they hit the cities. And for the first time, they needed access to short-term credit to deal with problems of cyclical unemployment and challenges of urbanization. And that created the Uniform Small Loan Law and other sorts of reforms. By the 1970s, we kind of got the onset of the modern consumer financial era, which is credit markets became more national. We saw, for example, big department store chains that were operating national systems. We started seeing debt collection across state lines, for example. So even technologies we take for granted, for example, easy access to long-distance telephone services totally revolutionized consumer finance in the country. Debt collectors who could easily make phone calls across state lines and so could escape state laws fairly easily. Or as we're saying, department stores, marketing of credit cards across state lines. And so they created as part of that the National Commission on Consumer Finance, which was this blue ribbon presidential commission that published a report that was in many ways the template for what we were doing when we came around in the 2020s, and they provided a framework for the next several decades of consumer financial protection, of certain principles to lay out. So in 2020, in January 2020, Director Kraninger established the task force. There were 5 members on the task force. And it was a remarkable group to work with. I was honored to be the chair, but we had Howard Beals, former Director of Consumer Financial Protection at the FTC, Bill McLeod, who had also held that same role at the FTC, Gene Noonan, a very skilled lawyer who worked for something like 20 years at the FTC, was the first credit practices attorney at the Federal Trade Commission, later was general counsel at the Farm Credit Administration, and Tom Durkin, who I know was yet another lead speaker, I think right after us, who I think everybody would agree is by consensus, the greatest consumer finance economist of his generation. And so it was a great group to work with. And she gave us we basically had 3 components to our mission. The first was to assess and evaluate, to come up with a consensus report that assesses and evaluates the current system of consumer financial protection and how it works for institutions and consumers. Second, to propose recommendations for improving that system. And third, to do it in a year. Which was a formidable task. So we met in January, and as you said, the pandemic hit in March. And we were literally, the last day, our last in-person meeting, we were in the building the day that it was announced that a contractor who had previously been in the building the day or so before had been tested positive for COVID. They shut it down. They sent us all down, and we spent the rest of the year online. And so, and it provided some challenges for us, which is one of the things that were very important to us, was to get as much public input as we could. And so that was a little bit of a setback. We had a whole bunch of hearings scheduled we were going to do, and all these meetings we were going to do. And so we made the jump to online. We had all our meetings online, a lot of Zoom calls and that sort of thing. But what was fascinating about it, Tom, was that, as I said, our goal was to modernize, to study the system and modernize it, say how we should modernize it. And what we saw during the pandemic, we kind of had this bird's eye view of developments that were already taking place in technology and technological development that might have taken 5 or 10 years happen in 6 months. Contactless payments, use of alternative data, for example. When people don't have to pay their credit card bills and their mortgages and their student loans, but yet people need demand for credit, right? But to make ends meet, how do you underwrite loans when you don't have the traditional metrics of creditworthiness, which is, are you paying your bills on time? And so it was kind of this iteration of seeing what was going on out in the world, analyzing it, and kind of bringing that into our report, and in understanding how all these factors interrelate, because that's been the idea here, right? As I said, technology has been the driving factor for a lot of this in consumer changes. And so while the 70s was about nationalization of credit and those technological changes, to 2020s now is the internet, that, sort of locationless, fintech, all these sorts of opportunities for consumers and that sort of thing. And so we're able to really see it up close.
I should add to that, Tom.
Sure.
We really saw that in the mortgage market, too, so you wouldn't think about it. But in March of April last year, courthouses around the country shut down. So if you want to buy, even to refinance a mortgage, or if you're going to buy a home, you want to transfer title. Well, you can't do that if the courthouse isn't open.
Right.
So, remote notarization, for instance, is something that started to take off. A number of states changed the laws to allow more access. You could think about it for those of you who've bought a home and you had an appraiser come into your house. Well, obviously, in the spring of last year, not only did the appraiser not want to go in your house, you probably didn't want him in your house. And so greater use of desktop and other technology, automated valuation methods. And so you really did see, as Todd was getting at, that the pandemic kind of really did a push forward in technology. Now, of course, we wanted to make sure as safety and soundness regulators that we weren't taking additional risk, and we were regularly going back and doing evaluations and saying, okay, if on these properties we didn't do a full appraisal with somebody walking through, but we allowed essentially a drive-by appraisal with an AVM model, are we going to is that going to be as predictive of credit risk as it would be otherwise? And some of these questions are still unanswered. But again, you really did see a push where COVID kind of forced the mortgage process and the real estate process to reevaluate itself. And because again, it really was a reminder that not only consumer credit writ large, but the mortgage process really is so much person to person. And you really had to find a way to substitute for that.
Sure. So looking at the current, so here we're, I don't know if we're at the tail end of COVID, or I don't know where we are in COVID on the curve, but we are where we are. And so what challenges do you see today in financial markets for both the FHFA or the consumer protection, or just in general, the economic challenges that we face as consumers?
Well, certainly probably the most immediate for FHFA and the mortgage market writ large is that while you have had 2/3 to 3/4 of borrowers in forbearance, but leave forbearance and exit. And I'll say one of the things that really surprised me, was the significant number, probably about 30% of borrowers were quite literally somebody was sending in a check for 4 months mixed mortgage all at once and got caught up. Again, about a third of this. It really was a lot of people just, okay, I used it, I'm out, I'm gone. But all that said, we still have, a significant number, probably just over about 1 million now, where there's still borrowers in forbearance. The programs are coming to an end. And it's fair to say that the big bump back in the job market has kind of happened, and we recovered a lot of the jobs quite quickly by the middle of last summer, and you still have a number that aren't there yet. So trying to figure out for those sectors of the economy where it may not come back anytime soon, what are you going to do for those borrowers? How are you going to transition to something sustainable is probably the most immediate question that FHFA is going to have to face. And it's it's a much bigger deal for FHA, the Federal Housing Administration, within HUD, just because the typical borrower quality is much more subprime, if you will.
Okay.
Much more difficult borrower to deal with in terms of getting them back on their feet and sustainability. So that's one part of this. Obviously, and I know we'll get a little more detail on this, we've seen a crazy amount of price appreciation, the stability. I am somebody who thinks that housing markets go up and housing markets go down. I can't necessarily tell you when, but, the housing market is cyclical. I don't believe we've cured the housing cycle or the business cycle. So I believe we've got a few years, maybe if we're lucky, to really continue to build out the foundation of trying to get in a situation where the housing market is prepared for the next downfall. In fact, because we started building capital immediately at Fannie and Freddie when I walked in the door, we had a cushion for COVID. In fact, if we hadn't built capital, Fannie and Freddie would have failed from the losses of COVID. But we were able to put a cushion to try to have that stability in the mortgage market. But finding a long-term solution for Fannie and Freddie, I think it's just paramount. And there are other parts of the mortgage market. FHA is an example of where we do need to bring some long-term solutions there. And of course, there are greater issues about access and how do you have sustainable home ownership. And certainly I worry that there's a bit of frenzy to get people in the market today when it may well be at the top of the market.
Okay. And Todd, where do you think were the challenges today for consumers or in consumer credit?
Yeah, so I think that there's a few things going on, and we'll talk about some of our specific recommendations later. And I think one of the obvious things is that there's going to just be a simple, different agenda in Washington. They've made that pretty clear with the new director and his senior appointments. They are obviously ideas like equal credit and the like, racial discrimination, that sort of thing is a much higher priority, or very high priority for these folks. And I think that's one of the things that's going on. But I think another thing is going to be figuring out how do we deal now with sort of the adjustments that were made during the pandemic, people's rapid evolution, rapid transition to online technologies, contactless payments and that sort of thing. And one of the things that is done that we saw is it really threatened a lot of incumbent special interests, right? The appraisers and the people, the home mortgage and closing people and the traditional banks, right, who all of a sudden found people turning to fintech. And now they're kind of swarming back, and they're basically saying, let's see if we can jam this genie back in the bottle, because we don't like all this competition. And so I think one of the things for both the state and the federal level will be to see how that all shakes out. The extent to which we can preserve a lot of this innovation, but at the same time recognize that the rapid pace of change does create challenges for consumers and does create potential consumer protection issues that we need to figure out how to allow this transition and these technologies to develop so that we don't stifle them while at the same time protecting consumers from potential vulnerabilities that arise from it in a responsible way, whether it's equal lending, whether it's privacy issues, or whether it's issues in competition.
Okay. I would underline something that Todd touched upon, which is, and maybe this is, when I was doing my PhD, my really work was industrial organization, market structure, and I wasn't a finance guy by training, but really was someone who looked at competition. And it's perhaps that reason where I would really argue that to understand federal, financial services policy, you have to understand that a tremendous amount of it is really about relative market shares and fighting between parties within the industry. Absolutely. If you don't start from that premise, a lot of things that don't make sense aren't going to make sense if they fall in. So the competition aspects are incredibly important. And let me, I think, parse out something I think Todd really touched upon too, which is a really core fundamental policy debate is the role of risk-based pricing.
Yeah.
And so I'm of view that the growth, particularly, you forget probably pre-mid-90s was really after the 80s PC revolution, where you really had the growth of automated underwriting. There's a few of us here old enough to remember where most loans were manually underwritten. You went in and met a lender. I don't know if they still, how many of the C's they teach today anymore, but in terms of credit quality, and I would say pre-90s the definition of a good banker was you sat across the table from somebody, you looked at the ratios, but you had a really good gut feeling of, is this person going to pay me back or not? And we've completely, that is not the credit market anymore. The credit market is very much automated, computer-driven. And that really, in my opinion, has on one hand expanded the access to credit. So there's sometimes a bit of nostalgia in that pre-1980s, subprime borrowers largely did not get credit in the normal access market. Okay. And so we expanded access, which I think largely was a good thing, but we expanded by being a price for it. And there's always been a big push in Washington to get back to more average cost pricing, basically in an attempt to have cross subsidies via the. So to my summarize would be to really understand the structure of federal financial regulation. You need to understand, one, it's about market share among incumbents, and two, it's about using the regulatory system to impose cross subsidies.
Okay. And I would just say that I study small dollar loans, and largely those are still face to face, and so are in person, trying to get the measure of the borrower. Basically,
it is a really big. I know Todd teaches contract law, I believe, and I'm a big believer in the sanctity of contract and property. But it's also a good reminder that most disputes you're ever going to have are simply too small dollar to ever go to court and enforce. And at the end of the day, the most important part of business is a handshake. And looking somebody in the eye and getting an instinct of, push comes to shove, is this person going to honor their obligations or not? And that's still how a lot of the business world operates. No disrespect to the lawyers. I'm not trying to minimize the amount of business the lawyers get, but it's just an important thing to remember that, as the students go out into the world and operate in a business, don't simply think you can rely on what's on the contract. Reputation still does matter and probably will matter more than the contract at the end of the day.
Okay, so what I want to do is circle back a little bit because our faculty asked a couple questions, and I put it on my list here, and so all of us who are homeowners have noticed maybe there's a recent price appreciation.
Just a little bit.
Just a little bit, and in some areas of the country, quite a bit, especially like in the Rocky Mountain region, for example, and other places. But can you kind of fill us in on what's going on? You touched a little bit on it and said the housing prices go up, they go down. Do you foresee a rapid decline, or
well,
what do you see?
first of all, it's always important to keep in mind that you can see market prices change quite quickly. And
yes.
so the argument that it's always going to be a smooth transition, it sort of reminds me, I remember the arguments before 2008 when the consensus was, well, maybe things will slow. Or, I remember 2006, 2007 being in meetings with like Moody's and S&P and the analyst, and their assumptions at that time was like, well, we've got a 5% chance of a 5% decline. And even that, we think it'll grow.
Right.
So the point being is markets actually turn pretty quickly, sometimes even the housing market. It is fundamentally supply and demand, so let's think about that. First of all, obviously you saw rates just drop. We had record mortgage rates. Obviously they've started to go back up. That's been one increase in demand. You have the demographics where millennials are much more in the home buying mode. And of course you had a number of people during the pandemic sitting around their house and saying, boy, now that I'm here all the time, I really don't like the house that I have. And I'd like to have a house maybe with a little more, yard, or a little bit more in the suburbs. So you
Space for a home office.
Exactly.
Right.
So you saw a lot of these things. And of course, a number of places that one reason you've seen like the Boise's and the Salt Lakes become just boom is you've seen a lot of this movement out of California, where not only simply because of the tax situation, but people felt like they didn't have to be there. So I'm, I don't like to say myself either an optimist or a skeptic about remote work because I think it's more in the middle. Certainly for some businesses, it's not going to be sustainable for everybody to be durably remote. I personally, and this is something, I try to bring running FHFA is, I really am concerned for people coming out of universities and junior in their career in that, certainly for me, and I suspect it's true for all of us, that being mentored early in your career really makes a big difference.
Yes.
And how do you mentor people remotely? How do you bring them into the corporate culture, organizational culture remotely? These are incredibly difficult questions. And there a reason that I'm skeptical about everybody's going to go to remote work in the future. But at least in the interim, that did run some of the mortgage market. And of course, the flip side was, as you can imagine when I was talking about appraisals earlier, nobody wanted to have an open house in the middle of the spring last year. You're going to invite a bunch of people in the middle of a pandemic to come through your house? Of course not. And so, and also because you had savings rates just shoot up, partly because of the relief payments, but as well because people weren't spending on vacations and such, that you had very high consumer savings rates. And that's why you had record number of all-cash deals, record number of extremely large down payments. And so you just think about it again, simple supply and demand framework. Okay. Massive demand response last year with a massive contraction in supply.
Right.
That is not sustainable. Now the demographics are sustainable. We hope the income and job growth will keep demand. But we've already recovered all of the residential construction jobs we've lost. The permitting starts have been volatile, but they're higher than they've been since pre-Great Recession. So builders are trying to build. Obviously, we're working through some of the supply constraints. Ask anybody who decided they were going to put a deck on their house at the end of last year how easy it was to get lumber.
Right.
And so we started to work through, again, you've got supply chain issues. So my point would be, I think the next 12 to 18 months, you're going to start to see continued demand, supply response in the housing market. And you're going to continue to see rates go up. That's going to dampen some of the demand response. So again, it's Econ 101.
Sure.
Prices are going to moderate. In some markets, they're actually going to fall. But this is really a 12 to 24-month story.
Okay, thanks, Mark. So I want to pivot a little bit here and ask Todd a question I've been thinking about for some time. And that is, If you haven't read the task force report, it's 1,000 pages all. There's 101 recommendations in it, so I guess there's 101 Dalmatians and 101 recommendation for each one of them. But you did make over 101 recommendations, and many of them concerned research and other regulatory tools that was brought out in the report. So I think that term regulatory tools is kind of new to the vernacular in regulation. So if you could just talk to us a little bit about what these regulatory tools are that you identified in the task force.
Yeah, and this is one of those things that that sort of, when you work in government, you come to sort of learn how these entities work, right? Because it's different from working in a corporation or something like that. And it's something that I think people, even lawyers often on the outside, don't appreciate. And so the regulatory tools are basically, an agency will have its end, a goal, that a purpose, right, for the CFPB. There's a variety of purposes set out in Dodd-Frank. And there's a variety of means you can use in order to accomplish that end. And so CFPB is unique, as far as we could tell, in the world, in that it has 5 different regulatory tools. It has enforcement, regulations, supervision, consumer education, and research. And one of the things that we, as I mentioned at the outset, we were trying to help the CFPB think about moving from a startup to a mature organization. And so we drew on the task force combined. We had over 150 years of experience working in this area, worked in a lot of different agencies, especially at the FTC, had a lot of different experiences. And so we drew on that to try to help the CFPB think about how do you use these tools together. So, for example, one of the arguments we make, and we've been talking a lot about the modernization and providing flexibility in the regulatory framework. One of the things that's going on, obviously, is the world is speeding up, is accelerating at an accelerating rate, right? The rate of change is not only faster than it's ever been, but it seems to be accelerating every day. That puts a lot of stress on our financial regulatory system because, as I described earlier, this is not a system that's set up to be adaptability, right? Which is the banks really like long, detailed, specific regulations that tell them exactly what they can and cannot do, right? Certainty, 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 right? And so we've got these huge thicket of regulation that's very prescriptive and very rule-bound, and creates a problem in a situation like the pandemic, where all of a sudden you need nimbleness, you need to be able to adjust. And this is why I congratulate Mark and Director Kraninger for making this very cumbersome system work in a way that was consistent with the law, which I can't say that everything that was done in 2008 that I could say that about, but I think this time they really operated within the system, used the flexibility that was given them to make it work, but it really showed the need to provide a system that could breathe more, right, that could deal with this adaptation. So one of the things we talk about a lot in the report is what's called principles-based regulation. And one of the things we observed about the CFPB is that the CFPB would often do what was called regulation by enforcement, which would basically be, rather than doing a formal rulemaking, they just start bringing cases that would try to establish general principles, or try to use supervision in a way that would be sort of regulation, for which they got in trouble for Congress, the Congressional Review Act. So what he said is, no, regulation is something that should provide a framework for sort of what the agency wants to do, and then you can use these other tools like supervision, and you can use enforcement within that to flesh it out and provide the flexibility within the system. We also talked about consumer education. Consumer education can do some things, but it can't do everything. The modern financial system is just too complicated to deal with everything as a consumer education problem. Consumer education be powerful in supplementing that and empowering consumers to make good choices. But if I ever meet the guy who came up with the idea that every time I go to a website, I've got to check the box, I agree to their principal policy, if I ever meet that guy in a dark alley, only one of us is ever coming out again, right? And the point here is those are problems you can't solve by disclosure. People aren't reading those. And people aren't reading all these documents. And so what you've got to come up with is a system that understands how do people actually shop for things? How do people process information? How do they make these decisions? And you can't write these long, detailed regulations that deal with that, or unrealistic regulations. You think about how to use consumer education in connection with anti-fraud rules, right? And that sort of thing. Research, it turns out of our 101 recommendations, we often did joke that every time if we dropped a recommendation, we had to add another one so we keep our Dalmatians intact. But of all our recommendations, there are more recommendations for research than any of those other categories of tools. And the reason is that we call it policy research and development. Research tells you what's going on and where you should be going. It tells you how to understand how consumers are making decisions, choices. There are huge areas where we just don't know hardly anything. A great example is we've talked a lot about financial inclusion in this country. But one thing we haven't talked very much about that I'm sure people in Mississippi probably can relate to is we know very little about the financial inclusion challenges of rural populations. And those are really challenging in the sense that not only has the financial environment changed so that smaller banks and rural communities are closing, but people in rural communities can't just hop on the internet. They don't have they don't have as good internet service, cell phones, all that sort of thing. So we need to really understand the financial inclusion challenges of rural communities as being different from the financial inclusion challenges of urban communities, for example. And that's just one of many examples of things that in order to develop better policies, we need to do the primary research to understand what's going on. And that covers a whole framework of a whole array of these questions.
Okay, so of the 101 recommendations, do you have any that stand out you think are the most important?
Yeah, and one of the things that was interesting for us, Tom, was, I mentioned the National Commission on Consumer Finance, and it turns out the principles that they identified are evergreen. The world has changed, but not the principles. They identified 4 principles for a consumer financial regulatory system. Consumer protection, right, protecting consumers from oppression and fraud, right? Inclusion, competition, information, and we added a 5th, which is modernization, which was involved in theirs. So our recommendations fall under those headings. And one of the things I think that is important to recognize is that we were writing this, that we were following the NCCF's template. We knew we were writing our report during an election year.
Right.
We knew there was a good chance there could be a new president and a new director, within weeks after our report coming in. And so we wrote something that was designed to be good for 10 or 20 years, for 2 decades. The NCCF recommended the creation of a National Consumer Protection Agency. It only took 40 years for that to happen when the CFPB was created. Hopefully some of ours will come into being before then. But I think a lot of our proposals should be agreeable in a bipartisan way. And so what we focused a lot on in particular, and I think what we're particularly excited about, are the inclusion provisions. And we identify a lot of things that could be done to promote inclusion. Primarily what history teaches us is inclusion is best promoted through competition and consumer choice. An experience of widespread access to credit cards beginning in the 70s with the deregulation of interest rates is a good example. And the ability of alternative financial providers to offer credit products that basically broke the back of the loan sharks in the United States, which is a big problem in this country. Sure. Competition, and so we have a lot of recommendations for that. More industrial loan companies. There's no reason why Walmart shouldn't have a banking charter if Walmart wants a banking charter. More fintech. Broader chartering of credit unions to serve lower income communities. Broader use of alternative data for people who lack deep credit reports and the like. And a lot of those sorts of things that promote competition, as well as clearing away some regulations that are pretty clearly harmful on net or amending them to lower income consumers. So, for example, the Durbin Amendment as part of Dodd-Frank has been a disaster for low-income households in raising bank fees and losing bank accounts. Provisions of the Credit Card Act, have been particularly counterproductive. So, for example, a good example is this. There's a provision in the Credit Card Act of 2009 that makes it very difficult for college students to get credit cards. Well, you know how you can get a credit card? You can still get a credit card if you have a co-signer. So what does this mean? It basically means that if you're from an upper middle class family, mom and dad will sign, you can get a credit card, you can graduate from college, you've got a credit report, and you're well on your way to getting more credit. But if you're from a lower income background, there's no co-signer who's going to sign for you. You graduate from college, you don't have any credit, and what we find out, you don't have a credit report, right? And what we discovered in writing the report is if you're credit invisible when you're young, meaning you don't have a credit score, you're more likely to be credit invisible when you're older, right? And so this provision, which was just made up, pulled out of the air without thinking about it, ends up really detrimentally hurting the people it's supposed to help, right? While, like so many of these other things, lower income people end up being hurt by this, while upper middle class people and the like just slough it right off. And those were the kind of things that we really wanted to focus on, were these regulations that harm lower income people and financial inclusion.
Okay. Well, I just have two more questions before we'll turn over to the questions and answers. So be ready. And actually, one of my questions. Oh, go ahead, Mark. I'm sorry.
I want to say how strongly I agree with Todd's take that the solution here is competition. But I want to perhaps add a counter to that we need to think about, which is, I put it this way, if you have an environment with very aggressive competition in which the competitors are all written by government guarantees, then I can guarantee you that we will be paying on those guarantees as taxpayers. So the question is, how do you have a very competitive environment when you have the existence of extensive moral hazard from the guarantees? Yep. Now, the hope is that we move away from all the guarantees and we actually have competitive markets. And it does get to a fundamental problem and a real failure, if you will, of our financial regulatory system. It is not a system that can tolerate failure of institutions. Yeah. And until we fix that, the system itself cannot allow to have
cannot psychologically.
So that's just a flaw at the heart of it. But,
okay. Yeah. So over the years, I've talked with you both, and one of the things I always like to talk about is what makes a good leader? What do leaders do that makes them good leaders? And I know that both of you have some pretty interesting opinions on this, or things that you've done, things that you would do. And so I'd like to start with whoever wants to go first. I'll go with Mark then, and say, what did you do as a leader at the FHFA that you thought was novel and unique and really helped your employees?
Well, thank you, Tom, for the question. First, I'll start with an observation. There's something in the federal government called the Federal Employee Viewpoint Survey, where we ask, employees, what do they think of management? Okay. It's done annual basis, and I'm very proud of the fact that during the time I was there, questions about, like, do you trust senior leadership? Does senior leadership have integrity? We increased by over 20 percentage points, on a scale of 1 to 100, which was almost unheard of. Right. So we really did take an agency that was directionless, demoralized, and we regenerated it, and we gave it purpose. Part of it was, as I mentioned, it was directionless. There were debates about the future of Fannie and Freddie, whether the agency would stay around. So I think there's a couple of things that I would add to leadership. First is critical to be seen. And, my first day on the job, walked every floor, knocked on offices, said, hello, I'm the new director, would like to know what you'd like to do. And so I just think it's important to engage. And, I heard, people say, boy, there'd never been a director on the 5th floor before. And so you just cannot run an organization where you're some distant from the people who are actually engaged. It's also, remember, and I had a regularly quip that, well, I don't actually do anything. I just direct other people to do it. And the point being is that you have to recognize that motivating, was a really big part of it, whether it's the federal government or any organization. I also am just adamantly against micromanaging. You have to set a clear vision. Here's the objective. Here's where we're trying to go. Here's how we'll go there. And it became almost a running joke in the agency that, people would say, well, this is what the director wants, and this is the question we're going to bring to him. And people would say, well, this is what we think he's going to say. And 9 times out of 10, they would already come in and know what I was going to say. And that's really the objective, is set a clear vision, set a clear philosophy, In that way, people don't have to come and necessarily ask the leadership what the answer is. They know what the answer is by the philosophy and the principles you set forth and the objectives you're trying to achieve. And most importantly, a federal agency. I always went back to and said, I don't have my agenda. The employees don't have our agenda. We have a law that has been handed down to us by Congress, and Congress sets our agenda, not me. And so always go back to what does the law say? What does the philosophy say? And again, being engaged. And I'll leave with a sort of story. When I started at the agency, and we were about 700 employees, and I'd said to my chief of staff, I want to meet every single employee at the agency. I want to be across the table from them. I want to have a conversation with them. Obviously, COVID threw that off, so we did virtual coffees with about 10 people at a time, and happy to say by the time I ended, I had 675 individual conversations with people throughout the agency. It is fun things. I would ask them to tell me what they've been doing during COVID, and it was so heartwarming when people would pick up their pandemic puppy on the screen and tell me about their new puppy they'd gotten during COVID. And again, it's just treating people as if they're important. And lastly, let me say, one of the things I did pretty regularly, and it goes back to my time on the banking committee. While I was very fortunate to be able to work on the legislation creating the agency I worked at, now, I also took phone calls during the Great Recession from families that were facing foreclosure the next day, whose house was going to be auctioned off, and they wanted Congress to intervene. Obviously, there was very little Congress can do to stop your foreclosure if you're calling the day before it's been auctioned off. But I'm also, so I took those phone calls. I was also proud to say that the food service workers who worked the cafeteria in the Senate figured out where my office was at and brought their mortgage documents to me and said, help me figure out the situation I'm in. And the reason I raise this is that every time we would do staff orientations for new employees at FHFA, I would remind them, you are responsible for the safety of the mortgage market. If you don't do your job, people lose their homes. People end up on the street. And it's not to put a weight upon anybody's back, but it's just to remind them that their work is important, and everybody needs to hear that. And they need to hear it in a greater context of why their work is important. And they also need to hear what happens if they don't do their work and the negative consequences. And again, making sure that people were part of that. And lastly, let me just say, I'm a big believer in that a lot of organizations, whether it's companies, whether it's government agencies, whether it's academic departments, go sideways because somebody somewhere knows what's wrong, but they can't get the people in charge, they can't get the information to the right place. And so this is, to me, the heart of what diversity, inclusion, belonging, whatever have you really means, is that everybody should be able to feel like they can raise their hand when they see something that's crazy, that shouldn't happen. And if you're an organization or leadership that doesn't listen, then you're going to go off. And so, again, I would end with saying, to me, the single most important characteristic of good leadership is modesty and humility.
Okay. And Todd, like many things, I know that you study many things and have views on interesting things like leadership of a federal agency. And if you could just kind of summarize what, things you've read or things you've seen, things that you would do if you were in charge of a major agency or provide advice to someone who's in charge. I think that would be very interesting.
Yeah, there's some interesting things about federal agencies, which is number one, for a lot of these things, virtually the entire economy could be part of your regulatory scope. So the first thing you have to do is decide what are going to be your priorities to work on. And so the second thing that Mark sort of alluded to, I think, that I've observed is the way in which we think about the world through a lens of markets and spontaneous order and competition and consumer choice. That is not the natural way that government bureaucrats think about the world. And so we have this sort of sense of what Mark said, I think, really applies in a very fundamental way, which is articulating the vision, explaining the vision, and most important, having a positive agenda where you can go to the staff and say, look, I'm not here to just burn the place down and just get in the way, right? I believe in consumer protection. And let me explain how we're going to do it. And let me explain why if you buy into this vision, even if you don't understand it at first, it's actually going to accomplish why you came here to help consumers. I came here to help consumers. There are different ways in which we can do it, and I'm happy to answer any questions you have about why I think this is better, or and why the way it's been done is counterproductive for consumers and that sort of thing. And so I think this is a very important a point, which is to have a positive agenda, and then constantly articulate it in a simple, clear way, as Mark said. The best questions are the ones that don't have to be asked because they already understand the answer, right? And so when we were talking earlier, we had five goals in the task force: inclusion, innovation, choice, competition, right? And modernization, right? And we just said it over and over and over again, right? Everybody could say it in their sleep. They knew exactly what our overarching vision was, how the whole report was going to fit together. And if you bring that to an agency, I think it really makes a difference. And then you allow people to run with it, and you help people direct it. And I think that what Mark did, FHA was really a great role model in how somebody who believes in markets could come in and make a change in the culture of a place to understand and explain why you're doing something, how you're doing it, and bringing in people who can help reinforce that and understand and articulate that vision.
Okay, so in light of some recent Supreme Court decisions, which has affected some of us in the room, and actually even at the CFPB, the Supreme Court has ruled that a single director that cannot be fired is unconstitutional. So having a sole director in essentially an executive agency, they serve at the pleasure of the president. And so in light of that Supreme Court decision, what do you think the new directors need to do differently, if anything, or will there be a change in the way the directors operate?
Well, and not to sound like a lawyer, but certainly the previous standard was for a cause, and and that doesn't mean you can do whatever you want.
Right.
And perhaps the difference would be that you couldn't fire somebody because you ordered them to not enforce the law. Now you can. And now that much of because if you start with the Syria law, CFPB, and Collins, which covered FHFA, and in my view covers OCC as well, and you start from the FDIC, that's half of its members are the CFPB and the OCC heads, we really see a sea change in a sea and a half where very broad parts of our financial regulatory system are no longer independent of direct political control of the White House. Now, and I mean this in a very nonpartisan way, every White House would love to see the housing market and the financial markets and everything booming before an election. Like it's a fair starting point. So I really think you have seen, we are entering territory of a greatly politicized financial regulatory system that really deeply concerns me, because I believe it was the politicalization of our housing and mortgage finance system that really contributed to the last crisis. So short answer is buckle up. It's going to be a rough ride. It's not going to end well. I do think that both CFPB and FHFA should be reconstituted as boards, independent of the executive branch. And I think we would have much more stability that way. We're also at a point where, the OCC, the FHFA, and certainly up until very recently, the CFPB all had acting directors. And, there's even if you're removable at will by the president, and I don't just say this because I was confirmed by the Senate, but people who have been confirmed by the Senate bring a legitimacy and accountability that somebody who's just acting put into place doesn't have. And so I do worry that it's undermined the independence of these agencies, even within the executive branch, because essentially they're all at the whim of what some random White House staffer is going to yell at the person who thinks they may or may not get the job. So this is not a good situation, regardless of who's in the White House. It's really an unsustainable situation that, in my opinion, will end very badly for our financial markets. And I hope that Congress, sees fit to take some attention and fix it.
So what are your thoughts on it, Todd?
So in Federalist 51, Madison, the lawyer's got a lawyer, right?
Right.
In Federalist 51, Madison observed that there's this trade-off in any government institution between independence and accountability. The first challenge is to have a government that can control the governed, and the second place, oblige it to control itself. And this is the tension you run with these things and with these financial regulators. And Mark said the financial system has been pretty unusual in the sense that we've had this proliferation of these independent entities, the OCC, the FDIC, right? More than any other area of the economy, the history of the country has ended up this concern about entanglement between politics and in financial regulation, which sometimes I think might be more theoretical than these protections may be more theoretical than practical, because we all know that there's been political influence, and we all know that Ben Bernanke of the supposedly independent Fed and Hank Paulson of the Treasury were singing from the same hymnal during the 2008 financial crisis, right? But the point is that you have to have this. You have this trade-off between independence and accountability. Traditionally, the way in which that was done was you could have accountability through the electoral process, which was through an executive appointment, or accountability through a bipartisan board structure, which were basically the internal deliberative process basically provided a whistleblower type influence on any majority on that board, right? And so basically the dissenting commissioners could write a dissent. Things could go to court. Courts could supervise it. These beasts that kind of grew up around financial regulation, these single-member independent directorships, always fit uncomfortably within our constitutional system. I think that it was probably inevitable that they were going to go down one way or the other. And I think what we see here is basically an idea that there's no there was not either mechanism of accountability, right? Either direct political accountability or this whistleblowing function that you would get with bipartisan boards. Whether it made a difference in practice, I'm not sure, but I think that what we've ended up now, unfortunately, I think with these agencies is they were structured with the powers of an independent agency. But now they've got the accountability of an executive agency. And I think what we've ended up with is perhaps the worst of all worlds, which is the powers of an independent agency without that accountability, combined with the politics of the executive branch. And in a world in which you had a functioning Congress, they would come together and revisit the structure of these agencies in light of what the Supreme Court did. But I think what we're going to end up doing is muddling through, hopefully muddling in a good way, not in a disastrous way, as Mark said. But I'm certainly not going to disagree with Mark's concerns, which I think are valid, that we could be in the worst of all worlds now.
Right. Okay. So, being an inexperienced moderator, I still have some extra questions, but I want to make sure we have time for anyone here who has questions, and we have portable microphones so that you can appear. Here's your chance to be on TV. Yeah. So don't everybody go first. No questions? You still thinking about it? Oh, Todd has a question, and Frank has a question.
I was just curious to see your thoughts on crypto.
We'll need to get you a microphone so you can go out on, sorry. We can hear you fine in here, Todd, but.
This has been very interesting. I was just wondering about your thoughts about maybe any future, the future of cryptocurrency and how this relates to consumer protections and this kind of thing. We've seen, huge price increases, decreases, people losing fortunes. And I guess it's not exactly the same, but the penny stock trading and Robinhood and GameStop, and I think a lot of people are kind of not necessarily making the best choices for themselves. Some people it's working out, others it's not. So just any thoughts about how you see that going?
Yeah, I'll jump in because I am very bullish on fintech generally, which is I think the opportunities for fintech for consumers are unbelievably expansive, right? The basically elimination of geographic boundaries around the provision of consumer financial services is a huge revolution, and especially, I think, for traditionally excluded consumers. And so especially things like using alternative data for underwriting. But the other thing that we're seeing is especially a generational change, and we talk about this in the report, which is younger generations are just using financial services differently. And what we're seeing now is a great unbundling of financial services, of using Venmo for payments, and using some online lender for credit, and somebody else if you want to get a car loan, or all these different sorts of things where it used to be you had a bank account, and a bank account gave you all this stuff, right? It was all bundled together, and it was sort of an expensive, cumbersome thing, where now we're seeing a variety of options. And I think fintech kind of unleashes that and unleashes the power of competition for consumers. So I'm bullish on fintech. I'm uncertain on cryptocurrency. And from my view, I'm still trying to figure out what is the use problem that cryptocurrency solves, right? So we know that cryptocurrency is often used for these speculative purposes and buying and selling Bitcoin and these other things I've never heard of, right? That whatever decides when Elon Musk gets bored and decides he wants to move some market, he just tweets about it and nobody knows what it means except they start buying it or selling it for reasons I don't think they understand. So it's not real money at this point, cryptocurrency. I think the idea of something like a stable coin has potential. One of the things we argue that I believe in strongly is giving non-banks access to the payment system, because right now the banking system is a choke point for people actually being able to make payments to merchants and each other and that sort of thing. Cryptocurrency will evolve if we don't evolve the payment system to allow people to make payments without having to have a bank account. But I would prefer that evolve basically through market forces and competition rather than essentially just being a way of running a cumbersome regulatory process. That, I think, would be healthy innovation because it would be solving problems for consumers rather than just trying to avoid, outdated regulation. The other thing I think that's related to that is faster payments, which is forever the Fed. I don't know why they can't get their act together on this, but one of the things we discovered in the task force, or at least we sense, is a lot of use of things like payday loans and that sort of thing is check cashers, is because you take a check, your paycheck to the bank, and you can't get all the money for 2, 3, 4 days, right? You deposit it on Friday and you need money that weekend. You can't get access to it. And so people end up taking it to check cashers and things like that. So faster payments, I think, is part of this as well, which is not crypto again, but it's also basically the ability to access money online, digital formats, and that sort of thing.
I think there's a real financial stability aspect to blockchain, distributed ledger technology. And if you go back, particularly look in the equity market, so you think you may go buy a stock one day, you talk to your broker, and you think you may actually physically receive it at the same time. No, it's not instantaneous settlement. We saw this probably most dramatically when Lehman failed, when people who thought they bought something hadn't actually received it. And we certainly are seeing this in mortgage markets, trading of MBS. And so my point being is a lot of institutional problems where we decide we're going to rescue somebody rather than resolve it via bankruptcy or some sort of resolution receivership is partly because we have this period between execution and settlement of a trade where the easiest thing is just to wrap taxpayer support around it and not deal with it, which is what we usually do. But I think if we can get to a world of where, rather than plus T 1, 2, 3 days and 0 instantaneous settlement of trades, you can bring a lot more stability to the system, in my opinion, because you don't get this mismatched books. And so I'm bullish on the blockchain, but probably more bullish from a proprietary blockchain than I think from some of the public ones.
Terrific. So, Mr. Lee, Drew will hand you a microphone.
Thank you. Todd, when you were explaining what a fantastic idea it was to create the CFPB, I paid particular attention to that. And you were explaining that, consumer protection was spread across multiple agencies, but one of the places you didn't mention are the state regulators.
Yeah, right.
And I wanted to see if you could give us your perspective on state regulation as it relates to consumer protection.
Yeah, no, that's right, Frank. And traditionally, the states have been the repository of most regulation here, and it still should be for a lot of these things. One of the things that I think is interesting that we discussed and the CFPB needs to take under advisement is what I think we should be doing is focusing on this from a consumer-centric perspective, right, which I call it the ecosystem of consumer credit, which is traditionally the way we've regulated are in these silos. We've got federal regulation of banks, and they do all these things for banks. So you've got state regulation of personal finance companies and payday lenders and the like. But that's not how consumers shop. So what we know from consumer behavior is that for the alternative for most consumers to take a payday loan, the next closest alternative is bank overdraft protection. These are people who don't have access to credit cards. The next line down is in states that allow it are personal finance companies. But in states that don't allow it or people can't qualify for those, it's basically either bank overdraft protection or payday loans. Bank overdraft protection has traditionally been regulated by the federal government through a safety and soundness rubric in a prudential sort of supervisory type way. Payday loans have been regulated by states under a licensing type system subject to consumer protection laws. And so knowing the optimal strategy for payday loans also requires you know what the regulatory strategy is for overdraft protection. And so putting this system together now around consumer choice, I think that's the challenge, is to figure out how to create a more streamlined system for consumers that puts states where they should be. And one of the problems we see in the states is a lot of things like licensing laws raise the cost of financial services to consumers. And one of the things we saw, as Mark was referring to earlier, was a lot of these state laws, these notary laws and requirements of wet signatures on mortgage documents, which didn't work very well during the pandemic either. Right? These are just incrustations of old, special interests who just gum up the system and get their little piece of the pie on all this sort of stuff. And so I think states could do a lot to reform their own licensing laws, to adopt laws that allow for more innovation and competition and on their own right, and can really be experiments in places where they could really innovate in a way that could be a role model, I think, perhaps for the federal government in a lot of these situations.
Maybe this could be an area where I may take some difference on perspective on some of this stuff for Todd, because I wouldn't want to make it sound like we agree with each other on everything.
That's right.
But so for starters, certainly my perspective would be, if it's a transaction that takes completely within a state, you're a Mississippi institution, your consumers are Mississippi, I fully trust the state of Mississippi to make those decisions without the federal government. And so some of what you see, the problem I have, part of where CFPB comes in is often this kind of, we're going to have a federal floor where we're not preempting. So it's one thing to say, okay, here's a particular market consumer that may be national in scope, and therefore people should be treated uniformly nationally. There's an argument for that. I'm sympathetic to that. That's not the CFPB approach. The CFPB approach is to say, well, we don't trust Mississippi, so they're going to have to live at our standards. But if Massachusetts wants tougher laws, they can do that. I certainly think that's the wrong approach, because you're not seeing the scale and uniformity you have. You have somebody deciding that their view is a one-size-fits-all. That's one perspective. And again, to me, completely within state bounds, there's no reason for the federal government to intervene. Obviously, I do think banking is fundamentally different because the charters are national, of course, with the exception of state chartered banks. And then you have the regulatory regime created because of the pod insurance. And again, going back to an earlier point, it would be one thing if consumer protection truly was about only consumer protection. But so much at the federal level, consumer protection is about redistribution.
Yeah.
And if you've got, and one of the reasons, again, there was this big knock on the Federal Reserve pre-crisis, and most of the Federal Reserve consumer protection staff were transferred to the CFPB. I'm going to set aside that if your argument was that the Federal Reserve failed on consumer protection, why you took the same staff that you think failed and simply put them at a different agency, believing they were going to do better this time. But putting that aside, at least my interactions with the Federal Reserve and consumer protections, they brought a market perspective to it. Even the lawyers kind of understood how markets worked there. And I do think that they also kept in mind that balance of safety and soundness. So you have to start with the world we have, which is financial institutions that have government guarantees. The government guarantees mean these institutions have the Modigliani Miller does not hold, so you're massively leveraged because you've got a put option on the public, and therefore you're thinly capitalized. So therefore, if the consumer protection comes in and says we need to go pay all sorts of big settlements, you go bust and the taxpayer bails you out. So the point being is it's an onion in which you have to deal with the various layers, and until you deal with those, and again, a criticism I regularly hear both from banks and non-banks is they point the fingers at each other and say, it's not fair, they have a better level playing field.
Right.
Well, the non-bank, fintechs, they're not getting deposit insurance. They're not getting government bailout. Community banks aren't getting government bailout. So until we deal with those issues, I don't know that we can have a break down the silos until you deal with the reason that we have the silos to begin with.
I hate to burst your bubble, but I think I do agree with the way you said it. I was describing the way the CFPB should operate, and unfortunately they don't. A good example is the payday loan rule, where not only did they basically preempt all the state laws on payday loans, they dictated a particular underwriting model that every payday lender in America would have to use, like they know this better. That's exactly the kind of thing that's wrong with the way the CFPB has actually carried out its duties as opposed to the potential of what they could potentially be doing.
Well, here at Mississippi State, our classes run 75 minutes. And my students are kind of instinctively start to squirm at about 73 and a half. And so we're at that point right now. But as you see, we'll have a reception afterwards where the speakers will be available to you. Introduce yourself, talk to them. You see that they're very articulate and friendly, knowledgeable, and just nice people. And so we have some food. We'll have the jazz band is on the way. Although, I'm sure they're here. So at this time, I'd just like to close the proceedings and thank Todd and thank Mark for coming out from Washington to come to Mississippi and enjoy this wonderful weather we're having today. So,
Pleasure.
Thank you, everybody.
Thanks, Tom.